Hey everyone, this is Addy. First of all, I can't wait until for September 13th when we have our free trading cohort live. I'll be coming to you on Zoom. I think I've sent the Zoom link, but if I haven't, I will resend it to everyone. I just wanted everyone, I just wanted you guys to keep a note, make a note of that timing, 11:30 a.m. Pacific. The trading cohort will run for at least 1.5 hours. If it runs over, that's fine too. I have time. I will have time to answer questions and everything. Today, I wanted to make a quick video of what's coming next in our first module on the day off. I just wanted to show you like how the structure of the whole presentation, how it will look like on the day, and the topics that we are going to cover. I'm trying to keep this video as short as possible, but let me know if you want to know anything about anything. Just let me know. Drop me an email. I will drop my email at the end of this call. Go to the website, contact us, whatever it is, um, make some comments on the video and just let me know anything. Anyway, first module, what we are going to cover, introduction to option selling. Uh, the idea is to give you all a overview of how options buying versus option selling works and why do we only sell. Why do we sell? Why don't we buy? I just wanted to take you through. I just want to take you through the whole probability side of things, just to ensure that you understand the numbers that I look at and make my decisions on. So the idea is give you actionable insights, meaning give you something for you to take home and actually click on it on our platform and make a decision, right? Rather than just listening to me and going through these slides and then forget about them and then never look at them again. Um, I want to give every one of you enough insight and enough ideas so that you can just go there, bring up your trading platform, bring up the paper trading account, and then start trading this thing. Anyway, just remember, options trading is difficult. It has its complications and it's tough. It's a learning process. So do not give up. I mean, it's the best skill that I've ever learned in the last 8 years. I've been on the finance side of things. I'm a CFA level 3 candidate. I've passed the first two. I just haven't had the time to finish my third one yet. Um, but trust me, all of that on one side and learning how to trade short options on the other side, because there's so much that you can learn here. There's so much that you can talk about. So much that you can. This is the real trading that happens in the world. So if you think of the big banks, big hedge funds, well, actually, hedge funds are on the buying side, on the buy side. The big banks, all the big banks, Bank of America, Goldman Sachs, J.P. Morgan, all their trading desks do on the option side is sell options to these buyers, and that's what you are learning. You're learning the trade that the banks do, with 70% of probability of success on your side. Anyway, quick rundown. Um, Again, four very important things to learn and keep there in front of you all the time. This is how I've been successful here. Trade very small, trade liquid symbols, trade high volatility symbols, and then trade the strategy that suits your account. Do not trade naked options when you do not have enough capital in there. And we will talk about everything later. I've put some slides in there. But like I said, always trade based on your account level. Do not trade what anyone else is trading, because that might not suit you. It might not suit your account. It might not suit your risk parameters. It might not suit your return objectives. Um, Next one, and I will take you to the trading platform right after this. Right after going through the slides here, I'll take you to the platform, and then we can discuss how to actually to do this on the platform. Which buttons to click? That's the idea. What to click and what to look at. Um, okay, call option. Basic diagrams. I've put 4 basic diagrams here, and this is the foundation of everything that we do. You need to understand how long calls work and how short calls work. And everything will just flow from here. Anyway, long call. Strike is 100. Um, this negative part right after 100, I'm talking about this one. This shaded area here is still negative. It's still red because you have to recover your debit paid on the long call. Let's say you select this strike, 100, and you paid $5 of debit to get into the option. This is that $5 that you have to recover before you start making any profit on the green side. So always remember, on the long call side, you have to recover your debit paid first before your option starts making money. Anyway, same on the put side, long put. You buy it at 100. The stock needs to go down by $5 first so that you can recover your debit paid here. Then it needs to go down further for you to make money, right? And on the x-axis, I put stock prices. On the y-axis is the P&L. Anyway, very basic diagram. Don't need to go into any details here. On the short side, again, very quickly, how does the short side work? It's exactly the opposite. When you sell a strike here, you sold 100 strike. And this is the short call option, meaning you are short the market. Short call means you are short the market and you have collected negative deltas. Now I will show you the whole Greeks thing on the platform as well. Anyway, you sell it at 100. If it goes below here, you're in positive. If it stays here, you're in positive. Even if it goes above you, it goes beyond you, up to a certain point, you are covered. That's the beauty of selling options. Even if it goes above you, like short call, meaning you're short the market and the market is going above, up on you. Even if it goes up on you, up to a certain point, you are covered. Only after that you start losing money here in the red. Fine. If it goes in your direction, best thing, you're always in the green. Same with the short put side. You sell this, now you are long the market. Short put meaning you are collecting long deltas. You are long. Rather than buying a call option, you are selling a put option and creating a similar diagram. Like similar payoff. Not similar diagram, but similar payoff. Okay, you sold a strike here, and then the market goes up. Yes, that's what you want because you are short put. You are long the market. So you are in the green. However, if the market goes down up to a certain point, you are covered. Only after that you start losing money in the red. Now, we manage these trades. We do not let we do not lose money on these option trades. We try to manage it mechanically. Now, I will show you that. Again, on the platform, it's easier. I mean, I'm a visual guy as well. I like to see diagrams. I like to see real stuff rather than reading words and letters and sentences. So the way I've created this is, again, some really real actionable items, but again, a snapshot of what you can do. Few words. In my presentation, you'll see less words, more action, more diagrams, more charts. Again, I've highlighted the sweet spots for me. If I was trading a $5,000 account, I would still keep it at $500 per trade because we trade futures options, and futures options are less down payment, meaning you can trade more and more often with less amount of money. That's the idea. I've highlighted the cells here, but always remember, you have to keep this. Print this off. Put it right in front of your computer. You cannot go above a certain percentage of your account for each trade. And overall, you can only use 50 to 60% of your account. Meaning, let's say, for example, you have a $10,000 account, right? You are in this row. 50% of that is $5,000. So you can only invest $5,000 at any given time. We keep some dry powder because when we get the opportunity, high volatility, we go and sell those options. So we always keep 50% to 40% in our pocket in case if we need it again. And then and you're using 50 to 60%, meaning you're using 5% on each trade, or let's say you're using you're basically within this range, 5 to 7 to 8% on each trade. And because we do spreads, I will be teaching you how to do spreads. You will not be using more than $800. Even 800 is too much. You'll probably be less than 700, somewhere around 500 most of the time. Um, so this is your sweet spot. If you have a $10,000 account, meaning you're only going to use 50% of your account, meaning max allocation is $5,000. With 500 on each trade, you can do at least 10 trades. 10 symbols, 10 trades, 10 different expiration cycles to diversify your portfolio. That's a really good way of doing it, right? I don't think you can do that on the long side. If you go out and buy options, or if you go out and buy stock, um, I don't think you can create a diversified portfolio under different underlyings and symbols with that much money. Anyway, let's go to the platform. So here's my paper trading account, TDMA Trade. Go sign up. I made a video on my YouTube channel on how to actually open an account and which margin account to go for. What access do you need? Check out my, if you really want to do it, just check out my channel. It's here. I think I made a video here somewhere, like how to open an account and what not to do. Anyway, I want to show you long calls and short calls here, and then we'll do a futures credit spread example, and then we'll take it off from there. Anyway, I'm buying an option. I will hit ask. Fine. This number needs to change. I need to do that on my site. You can set this up by yourself. That by default it should only bring up one. One contract at a time. Anyway, I'm 44 days out. Now, again, the question is, I need to be a certain days out here. Just increase the brightness so you can see properly. 44 days out, this is my sweet spot. I love this trading cycle. 44 days out, it's actually really good. So what did I buy? Did I buy a long call or I did a long put. Okay, fine. Add the money long put. So again, when you buy options, you have to add the money. Just a quick example here. Always make sure that you change this break-even points. Again, like I said, TD Ameritrade, the TOS platform is the best option trading platform out there. You can go out and use E-Trade and whatever rubbish is out there. I don't care, but this is the best one that I've seen. Because no other platform gives you this kind of functionality to go on the charts, analyze tab, do everything you need to do. Again, you're selecting this strike, right? 220, and then you're paying a debit. Let me just close this out so we don't get any notifications. Okay. 220, and then you're paying how much debit? $7 debit. So then the stock needs to first go down by $7, right? And then it needs to go down further for you to make money. Now, what is the probability of percentage here? Look, they're saying that the probability of this stock to stay within this range, by the way, the shaded area is one standard deviation move from where your strike is. Now, one standard deviation, it takes into account volatility, how volatile it is right now. Based on that, it will give you a standard range. So at this strike, 220, it can go up to, it can stay within the shaded area, fine. But 63% of the time, it will stay in this shaded area. Only 36% of the time, it will go on the other side. Now, also remember, these are slightly delayed codes, so take it with a grain of salt because the data is slightly delayed. Even though they say real time, I think this is delayed by 20 minutes or something. That's what it says somewhere. I remember it said it somewhere. Anyway, maybe it has turned into real time. Anyway, 33% of the chance of this stock staying here between this and that. 35% here on this side. So you have a 50-50 chance here. You don't have more than a 50% short here. Now convert this into a short option. So rather than buying it, you can sell it and then sell slightly out of the money option. We don't sell in the monies, we sell out of the money option. So let me just select this, right? Go back to trade. Sweet spot again between 20 and 15, so I'll select 20, 205, which is 20 deltas. So here I'll go down to set it at 200. What did I say? 205. So I'm collecting $3, $2.59. But look at the probability of success on my side now. 80% chance of this stock staying within the shaded area, which is where we make money. Only a slight loss if it goes below this point and that point. And we can manage that right away. If we see that the stock is going against us, we'll manage it. That's what I want to show you. 84% of making probability of success versus only 50% or 33% or whatever we saw. Now let's go into the sell call side. Long call is the same thing. I don't want to go through that example again, but long call is the same thing. But long short call, I'm going to sell at 240 because that's sitting at 17 deltas, which is my sweet spot. Usually, you can also see the probability of this strike being in the money. Always look at this column. This basically goes with deltas. Probability of in the money. Deltas basically show you like how probable it is for the strike to go in the money. So if you pick 17 deltas, meaning it only has a 17% chance of going in the money. When I say in the money, the stock actually going up on you, not down. But anyway, let's sell a call at 240. Let's pick the strike and do this. Now you would have noticed there's a slightly less premium available on the call side, and that's because the stock is down today. It's down $2. You can see here it's down $2. So the premium is on the strength of the market. Where the strength is basically on the downside because it has gone down a little bit. But look at the probabilities again, 82%. That's what we want. We live in this world of 82% probability of success. It only has a 17 or 18% chance of like being on this side, which is our loss side, the unshaded part. Only 17% chance of that happening, 82% chance of this happening, staying within the shaded area, and that's what we need. Sorry. Okay, next one. So I've shown you this. Let's just go through a quick futures options example, right? Today the markets are. I'm actually trying to put this trade in my real. Actually, let's do this. Let's try and put a trade on in this CL cycle, and I'm actually going to put this on in my real account as well today because the market is down quite a bit. I like the days to expiration, 43 days. Love it. Again, I've opened up CL, which is the crude oil market, and I will teach you all these symbols and different types of underlines and everything when we get to it. My sweet spot is 17 deltas, but I do not trade half strikes like this. So I will not trade 61.5 because look at the open interest and volume in this row versus one below it and one above it. So there's more volume and more interest in full strikes than in half strikes. So never trade half strikes, okay? This is again a half strike. We don't trade this. I would rather trade this or the one above it. Fine. Okay, what am I doing? CL market is down. Volatility has picked up a little bit, I think. Let's go to the chart. Look at it. Okay, so it's down to its yearly lows. So this chart is 1 day, 1 year, meaning it goes back one whole year from now. And look at the lows. It's towards its lows of the year. Volatility, if I have to draw a line here on the average side, it's around 37, which is fine. It's dipped a little bit today, but it is hanging around the 38 level. So I like this. I like the fact that the market is been down in this one. So I'm going to pick this up. Go to my sweet spot. I like 19 deltas here, which is fine. A little bit more credit. And then I'll go one strike out. In crude oil, So I'm going to put this down in the in all these slides. Like how many strikes far out should you go for a spread? Where to select your short strike? Where to go for your long strike for each underlying instrument? Meaning index, S&P 500, Nasdaq, Russell all have different widths. You call them strike widths, right? The width of the strike, meaning the width of the spread, meaning where should your short strike be and where should your long strike be. Then for crude oil markets, commodities, interest rates, everything, all the symbols that I trade basically all of them. So I will put it down so that you know exactly what we will trade. Anyway, I'm collecting 16 cents here, 16 ticks. Now each tick is $10. Let's take it to the Analyze tab and then look at it. Okay, great. I am getting a good trade here. 79% of probability of success. Perfect. That's what I want. Anything above 75, 73, 74 is okay too. Has to be over 75 for me most of the time. 80 is definitely perfect. If I go one strike down, I will definitely get. I think I want to get towards 80, but let's see. If you have to sell 61 and 60, what kind of credit do you get? $14. Okay, 14 ticks, not bad at all. I think let's take that. So now 82, perfect. Now I have the. I like to see 8 in front of this thing, starting with 8, and that's what gives me a good night's sleep here. Anyway, we're going into a short put spread. The reason being, the market has been down quite a bit, and we think that it's just going to do a risk reversal here. We're selling into the strength of the market because that's where the premium is. We sell when the markets go down. We sell puts when the markets go down, and we sell calls when the markets go up. Now, word of caution, I am really careful in selling calls. I've been bummed on that strategy before because the market has this positive drift to it. Like 70% of the time, the market will go up on you. It goes up because there are a lot of buyers in the market than sellers. So it always goes up. So we are careful in selling calls. I'm really careful when I sell calls. I don't normally do that anymore. Selling puts, selling iron condors or both sides of the market is fine. But usually on the put side, I do sell calls in ZBs and interest rates because I think there's a cap on it too. ZB trades has in my opinion, has a 125 cap, a support you can say. Anyway, back to this trade. 14 ticks, right? Oh, now it's trading at 13. So I want to still put it in as 14. Right click, confirm and send. So I'm paying $255 to put this trade on. I have a potential of making $70 to $80 in this trade. My idea would be to make 80 to cover the commissions. And if I make 80 and we are going in with like 255, what kind of returns are those? My calculator is not working now. Whatever, I think it's a nice ROI. 80 minus 10 in commissions, right? So you take home 70 divided by you put down 250. So that's a 28% return, right? Now, if you do this 12 times a year, once every month, given that you don't make any adjustments, your commissions stay where they are, which is unlikely to happen, but you can change the numbers here and there. Rather than 28, let's say 20%. 15 is my go-to number. After taxes, after everything, I should be taking away 15% from each trade. And if you have a big account, you can do these trades often and frequently. Then think about it, right? If you have $100,000 account, you do 15% net. That's $15,000 on your account. Anyway, let's put this in. Send, confirm and send. This was filled right away because it's a trading account. It's a paper trading account. Look, it got filled right away. And there's no P&L on it right now. So that's the trade. This is module 1. I'm gonna keep making these slides to make sure I'm covered for next week. We will have a full 9-module trading cohort next week. Most of the meat will be from module 1 to 5. One I've already discussed here, but obviously not everyone would have the chance to go through it. But watch the video, ask me questions, also suggest me what should I make content about. I mean, I know quite a bit about these, about these short options and options and all that. If you want me to talk about stocks, buying stocks and everything, I can do that too via the option route. I can do it by selling puts, or selling calls on the covered call side. So give me your suggestions. Let me know what kind of content you want me to cover. I can teach basically anything under the options umbrella, long or short options. I hope you enjoy this. Thank you very much for watching, and I can't wait to see you next week. Bye bye.